Welcome, everybody, to the Investors Podcast 2.0 Wealth Mindset, where we dive into the minds of the successful real estate entrepreneur to uncover the tips and tricks that have allowed them to keep moving forward. I am your host, Scott Bauer, and I'm excited that you're here with us. Welcome back, everybody. This is another episode of the Investors Podcast, and I am your host, Scott Bauer. Guess what? I'm excited today, real excited today. We got Mike Brown with us. Mike, where are you from?
I am in Northern Virginia, about 35 miles from Washington, D.C.
Okay. All right. So we got a lot to talk about just with your location, but Mike comes with a pretty stacked resume. I'm excited to have him on the show because he's been in the investment space for quite some time, 20 plus years. And really what he likes to focus on is helping, get the standard mindset out of investment. And when I say that, looking at alternative investments that you don't see in the stock market, right? It's super important, especially today. I think there's a lot more ways you can make money outside of the stock market and outside of traditional investments. And so I'm excited to talk to Mike about this today. Mike, welcome to the call, man. How are you doing?
Hey, Scott. Thanks for helping me. I'm looking forward to it. Doing great.
Absolutely. Now, I know that let's just get this started. Why don't you give the listeners a little bit more about your background, but I also want you to talk to tell them about the book that you wrote.
Yeah, great. Yeah. Well, I started out as an apprentice in a commercial real estate development company, and which is a great opportunity because it was a small boutique firm. So we got our hands dirty on just about everything. We did ground up development, mostly in the industrial office space. And we also did a brokerage and advisory work, and then started doing our own syndications and started our own investment fund. And in that process, we had to go out and raise money. And, every day I started, running out of our sphere of influence and our clients. So I started knocking on doors to financial advisors and wealth managers, thinking this would be a perfect opportunity for their investors. And, they was all receptive until, they disappeared, and they quickly found out that it was a conflict to their business. If their clients invested in any of our deals, guess what? Their commissions and fees disappear, and then no longer do they have assets under management. So I thought that was an inherent conflict of interest that really hurt the client. So we went out, and I also have gone through the Merrill Lynch program, worked at Merrill Lynch, had issues there about bringing people outside of Wall Street into alternative investing. And so we said, you know what, we got to fix the problem. So we now have a firm. We have two arms: Red Fox Capital, which is our real estate investment company. And then we have Red Fox Wealth, which is our quasi-traditional financial advisory investment company. So we've married the two together with experts in all different disciplines. And we're able now to give a no conflict, true investment advice to our clients. And it's worked out great.
I love that. And I think, the majority of the listeners that are listening to the show are in the real estate space. We have some syndicators, some big players in the commercial investment space. But for those that aren't, can you explain kind of the mindset somebody has to take on to look at alternative types of investments instead of the, your standard investment advice you're going to get from a standard financial advisor? Because I think it's really important for the majority of people to really understand the difference and how somebody might feel that an alternative investment is less safe when in reality it's actually much more safe, I believe, than
it could be. It depends on what you're looking at. Bitcoin would be considered alternative.
Right.
But real estate, absolutely. You have the asset there, you have the dirt, you have the building. So it's not like a paper stock that can completely disappear for no apparent reason other than the whim of the markets.
Absolutely. So, what else would somebody look at, for our intent and purpose? We're talking about real estate specifically, but, does alternative investments, you'd mentioned Bitcoin. What else is there out there? Do you only look at real estate, or are you given other options as well?
Well, real estate is my choice. That's kind of my expertise, but you also have private equity, where people can actually go into larger companies like Blackstone, for example. The problem with private equity is it's a long hold, and it typically, is on a hockey stick transaction. So there's really nothing going on in the beginning, and then it shoots up if it hits. So you got to be a long-term player in something like that. You obviously have your precious metals. You know, a lot of people now, you hear every time you turn on the TV, you see a commercial about buying gold or silver.
Yep.
So that's considered an alternative investment. You can even buy people's life insurance policies and hope they cash in quick. So, you know, there's all kinds of alternatives. I think the definition is, if it's not a traditional standard Wall Street product, it's considered alternative, as an easy definition.
So there's a lot of big box stores out there, right? Like the Merrill Lynch, like the TD Ameritrade, like the big box stores we hear of all the time. What problems do you see that they give to the marketplace? You know, and this is not hating on these companies at all, because they do serve a purpose, but
right.
I want to know what your thoughts are with regards to the issues that they actually pose for the general public out there.
Yeah, great question. I think, right now, when there's a race to the bottom for fees, with disruptors in the marketplace, Charles Schwab, for example, who really started that trend in the 70s to lower fees, discount brokerage. It's a race to collect more assets. So, whatever it may take, that's all management wants you to do, is to cold call all day long, no matter what, and bring in more assets. And now when the assets come in, the individual financial advisor is too busy to manage their investments or to really keep track of the investments, because they're too busy trying to bring in more assets. So what happens now is they've put it into what they call a managed portfolio, charge you a layer of fees. And a lot of times those fees aren't truly transparent. You may think you're only paying 1.5%, but there's other fees. I mean, a mutual fund fee on average is 3.6% on top of the advisor fees.
Right.
It's a horrible investment.
Right.
And so it's a game to get more clients. It's not about providing solid financial advice.
Now, I mean, and that's a traditional financial advisory firm, but there's also, fiduciary advisory firms that do not actually collect the fees based on the sale of a product or of an asset, but instead they're collecting the fee on, whatever your portfolio. Correct. And so they're Correct. Benefited by you and, by making smart choices for you, because that's the only way for them to make money.
Well, it's similar. In the Merrill Lynch side, you would have, because I have a Series 7, which allows you to be what they call a broker dealer. So if you ask me to sell some Amazon stock, I could do that for a fee. We're also fee-based. So we charge a commission for assets under management or our portfolio. So correct. The thing with the fiduciary is you have to put your client's best interest first. And that's how our wealth management company is set up. The problem lies in that financial advisor, they may be fiduciary, but they don't understand the alternative investment markets.
Right.
And someone, let's say Edward Jones or wherever you may want to say, they still say, Scott, I've got you in a diversified, truly allocated, well-balanced portfolio. I'm a fiduciary and I've got your best interest in hand. But in reality, they're diversified, but they're only diversified in Wall Street.
Right. Right.
Yeah.
Absolutely.
Yeah.
It's paper commodity, right? So it could go up and down. It doesn't matter. You have no control about that. And that's the thing with alternative investments that I personally really love. And I'm sure a lot of listeners do as well. So why don't you go into that a little bit more, a little bit deeper about your alternative investments, specifically in real estate, and what it is that you've seen that has been able to provide such a good return and a good investment option for people.
Right. So, we did a lot of ground up development in the past, and, we started to see a lot of our clients, ask for more stable income producing properties. So we've kind of switched our MO to that area for the simple reason you've got an asset. It's predictable. We know what the cash flow is going to be. They're going to get a check in the mail every quarter is how we do it. And there's so much front load risk in development work. So, what we may look at, the markets are always changing. We are agnostic to asset class. It depends on truly what is the best, what we see in the future. Right now, We've done some medical office properties. We are doing some triple net retail lease properties, and building a large portfolio. So if there may be a bad apple in there, it's not going to affect the overall performance of the portfolio. So for example, that we may piece together 10, 20 properties, take the cash flow, and then we'll reposition and sell it off as a large portfolio to an institutional investor, and our investors will get a large windfall. And we try to shoot for internal rates of returns anywhere between 10 and 13%.
Okay. Do you shoot for higher than that? And for the listeners out there that may not know what an internal rate of return is compared to just a standard rate of return, can you dumb it down for them? Is there a simple? And I only ask that question because I've yet to find anybody that can really dumb it down an internal rate of return, because the algorithm or what you have to use to figure it out is not really that simple.
Yeah, so basically it's a concept of your time value of money. So a good example might be where we go back to our development deals that I was telling you about. So let's say you put $1 into a development deal, and it may take us 2 years to go through the entitlement process before we even start construction. So that dollar is already counting in that time period, but nothing's happening to it. So if I go into a property that's immediately producing cash, our time on that dollar is starting to work sooner. So you can see it's affected by how long your money is actually in the deal is probably the easiest way to explain it.
Yeah, that's probably a good way to, and how long your money's in the deal before it's producing a return also. Right.
Yeah.
Or has any return benefit to it.
Right. Now I can turn around and pull out my textbook and give you the real definition, but it'll probably confuse you more.
That's what I'm saying. If you read a textbook definition, you're like, what did that just say? I have no idea what they just said. A bunch of words put together that tried to make it sound smart, but doesn't really make any sense, right?
And that's the other problem, Scott. If you and I are sitting here looking at S&P 500, and the S&P's done 4%, you can't equate that 4% to an IRR. It's different.
It is different.
And that's something that we have to educate our real estate investors on. And the IRR is typically a little bit lower than you would see in a traditional annual return.
So
it doesn't mean it's lower. It's just because of the time value.
So you're presenting these opportunities to investors that are used to doing traditional investments, and you show them the light of what an alternative investment looks like. Now, correct me if I'm wrong, but on, let's just say, a retail or a real estate deal, not only do you get paid on a monthly or quarterly basis, but you also get a tax deduction, significant tax deduction, depending on what asset it is that you're putting it into, and if you do any sort of cost segregation or anything like that the law now allows you to do. But then you also get a really big benefit at the end when you sell the asset, or if you reposition, or I'm sorry, if you refinance that asset. The investors in the deals are going to get another big bump. So to me, what I'm hearing right there, and I know I just said it, but you get paid 3 times. Why would everybody not do that?
I agree with you. And I think it's a lack of education. I think a lot of investors, there are a lot of people out there, buying residential homes, flipping homes. That seems more attainable for an average investor. They think commercial real estate is too complex, or they need a lot more capital to participate. And that's just not the truth. With the syndication, we, on the low end, we've even taken as low as $25,000 investors into large syndications. I have the discretion. If you want to come in and I think you fit well with our team, and we like you to be in the family, I can make that call. But yeah, you're talking about getting paid in multiple ways. The way we set it up, when you come into a particular deal, you get a preferred return. So we know what that's going to be. So our typical preferred returns are 8 to 9%. So you got that. And then as we go, that return may come up depending on, rent escalations, value add that we can bring to the bottom line, NOI, net operating income. And then you are getting all those you just talked about, cost segregation, your depreciation, your tax, things that are passed through. And then when we sell the property, you get what we call the windfall. So we get the big giant profit. I had a gentleman explain it to me this way when I was just starting out. He goes, a syndicated real estate deal is like having a CD. It's safe. You're going to get X every month, and it's attached to a lottery ticket at the end, because the windfall is going to be a huge thing. And then our incentive as the sponsor and the real estate guys is that we take a percentage of the performance. So we only get compensated if you get well exceeded what your goals are.
Yep, absolutely. And
yep.
And that's a performance-based operator that doesn't get paid until they perform is probably it's a results-driven business. You must take results if you're going to get paid. Yeah. And I think it's a great model for people. Now let's talk about. I'm sorry. Go ahead. What were you going to say?
I'm sorry. The one thing I was going to say is that the other rule that we have at Red Fox Capital is that all the partners have to have their own personal money in every deal. We will not let any investor come into a deal that we don't have skin in the game, which a lot of operators do not do that.
You're absolutely correct. A lot of operators do not do that. They just want to raise all the capital and then they don't have any skin in the game. And I think that it takes you out of the ownership side of being a general partner in a deal like what you're talking about.
Absolutely.
So for the listeners that maybe don't know how a syndication structure may look, doesn't always have to look this way, but it may look like this, where you typically will have a general partnership share and a limited partnership share. The general partners are the operators, the ones that are actually ultimately responsible for making the property operate, generating a higher NOI, improving the property, ultimately getting the bottom line up. That's their job. The other investment partners, the standard people that maybe put 50 or 100 grand in, they're limited partners and they don't have any operational structure in the deal. Their money is strictly what does that work there. And so they're the ones that are going to get a preferred return. And then they'll also get an additional return up and above that. Is that about right?
That's right. You're very good.
Yep. So, let's talk about the market itself. Okay. What do you feel like the impact of the market is? I mean, obviously we know that COVID-19 is something that's nationwide, it's global, it's got an effect on everybody. But what about, do you have a negative impact on the apartment sector that you're seeing or on the other commercial deals that you're doing? I mean, you talked about retail, you talked about, a lot of people are out of a job, right?
I would say this, Scott, that the only asset class that we've been bearish on, and it's been for some time before COVID, is general office space. Yep. For the trends, I think everybody listening understands. Office footprints are shrinking. You can work from home as easily as you can in the office now. Outside of medical, we've stayed away from any general office.
And that's the only asset class that that makes a lot of sense. We all kind of know.
And we used to do a lot of it. I mean, it's something that we've done a lot of, and it's too unpredictable. When tenants turn over, it's very expensive for build outs and to repurpose. So we've stayed away from it. We've moved more into smaller regional shopping centers, the triple net retail, like pad sites, you may see a fast food or a Dollar General, for example. We still play with some land speculation. And I think multifamily is a very hot topic. We personally do not do multifamily, not that it's bad. The reason is we don't have expertise in it. So we partner out with guys that are operators in that space. And in our geographic area, the multifamily is way too expensive to really get any kind of return for us.
Yeah, I would agree. I mean, it's been that hot topic for the last 5 years, really. I mean, it's really.
I keep asking when it's going to stop, and it never does. And
Well,
there's a housing crisis. So we know there's a housing shortage. So I don't, it's easier to finance. You can use a little more leverage on multifamily properties. So I think it's going to keep rolling.
so okay. So then let's push it out 5 years. Of course, nobody knows. I'm always interested to hear people's perspective and what you think is going to happen, in this next 5 years, and probably even shorter than that. Let's put it out 24 months.
Yeah.
What do you think the impact of the political environment that we're doing, not to get political, but just
Mm-hmm.
we're in an election year, right? We have this
Right.
massive pandemic that's caught everybody all in an uproar.
Yeah.
So what do you think the impact is that going to be on people, on this investment space that you're focused on?
Sure. Well, back in March when all this started to happen, we've had, a lot of high level conference calls with experts. And because everyone assumed that people were going to stop paying their rents. And, these properties, they're working on thin lines because of what it costs to get into them. So the good news is tracking those rental numbers that people made their payments. There was only a drop, maybe 3% in rental payments. So that's fantastic. We haven't seen any on the commercial
retail
side, office side. We've seen, there's been some pushback on some of the smaller retail centers. They're really in bad shape.
Sure.
So, in that case, but multifamily, I think it's going to be fine. And I think, the political situation, depending on which way we go, I think there's going to be a push to raise taxes, in the near term. I mean, we're sitting on $27 trillion of debt. The Congress wants to put out another trillion, multi-trillion-dollar package. We're at the lowest tax rate in our country's history. We know the Trump tax sunsets in 2 years. They're going after carried interest, which is important to real estate owners. That is where we're pushing off any returns, and we're paid in capital gains tax rates. So that will be a huge impact on us as operators. So I think there's going to be, I lived through and worked through the Great Recession, and I saw Obama's regulations, whether if you like them or not, crush small business. I saw the regulation from Obamacare either take companies out of business, or they shrunk in size to stay under the requirement for healthcare, or they retired early. Those kind of regulations are going to affect us. If Trump is reelected, I think we're going to probably have still another robust 4 years. And it's going to be a tricky road, but no matter what happens, we're able to position, because real estate, you got to have it.
Yeah, amen to that. And I think that's a good way to end that off, because either I'm bullish on it. People in the residential space, people gotta have a place to live.
Yeah.
Whether they lose their house, they gotta rent, right? Or whatever, they need a place to live.
Right.
There's got to be a place for business to transact. There's got to be, there's always going to be triple net lease opportunities, which for the listeners out there that don't know what that is, that basically is where you lease a building, but you're responsible for all of it. You're responsible for the taxes, the insurance, the maintenance, the T&I. That's your responsibility as a tenant. And as the owner of that, you pretty much provide the building, and then you get paid, you get paid every month for it. So it's a pretty good investment strategy, I would say.
It is.
Is that the majority of your investments that you're showing to people? Are these, commercial spaces like that?
Not always. Right now it is, because of the economy and where we think it may be going.
Mm-hmm.
If we start to reposition some small regional shopping centers, we may, try to add value by putting some pad sites in parking lots, and maybe try to get a lot of times when you acquire a new center like that, the leases could be scattered about.
Yep.
They could be different. So we, depending on where it is, what it is, we'll try to get that to a uniform lease and whether it be a triple net or some kind of adjusted, modified lease, we would try to do that. But, you know, the triple nets are great, just as you described.
They are great. Absolutely. See, I was thinking of something right there as we were talking about that. We talked about kind of where you feel like the market is going to go. Oh, this is what I was talking about. Let's say somebody that is listening to this call maybe is on the traditional investment route, and they think that they have a pretty good portfolio. They think that what they have is good. You know, their investment advisor has really given the hoorah and said, we're doing great. You know, the markets are up and whatever, but they probably don't truly know how well they're doing. Can you help them with that?
Absolutely. You know, I've created a system because, you know, I've worked with Scott, tons of software packages trying to analyze people's investment portfolios. And look, if you're an engineer or that type mentality, I can do that to you. I can dump spreadsheets until the cows come home on you. But we've created a new system where we take your financial life and we put it into 3 buckets. And one bucket would be what we call Wall Street products. Our second bucket are going to be alternatives. That'd be your real estate, your precious metals, any of the other things we discussed earlier. Mm-hmm. And your third bucket are going to be, you know, cash, things that are in the bank, CDs, cash on hand, the life insurance policy, anything that's really. So we try to make it really simple and show your allocation. And what's interesting is when we run those scenarios for people, 9 times out of 10, that first Wall Street bucket is overflowing. And the question you have to ask yourself, all right, Scott, let's say the Wall Street, we have a 40% correction next year. Can you afford to lose 40%? Because that's what's going to happen. Right. So depending on where you are in life and your situation, it's all about suitability. We have to rebalance that for people. So it's a great exercise at the very least to find out your balance. Now, if you're 30 years old, you can afford to take a crash. You have time to rebound. If you're 50 or moving toward retirement, you can't. You got to start reallocating those buckets. So absolutely, we'd be more than happy to provide a complimentary analysis for all your listeners, take them through that process, show them the buckets, and come out with quite an interesting analysis.
Absolutely. And I know that you sent over a link on how they can get registered or signed up if they wanted to do that. And I'll make sure for all the listeners that are listening to this, check out the show notes. It'll be there for you so you can easily access that. I think it's important on what you're doing. You know, I'm glad that you were able to come on the show today and, you know, explain kind of what you're doing with alternative investments, give the listeners a little bit about your background in the traditional investment space and how you've kind of moved into trying to help people understand a little bit better how they can make smarter decisions and what the impact of those decisions will be.
Right. And you know, like I say, it's really about the client. You know, I'm not saying you should be out of Wall Street 100%. What we're saying is you need to be balanced. And another really interesting thing is, so our new book, The Real Perspective, on Amazon now, is we took an analysis of a traditional S&P 500 ETF fund and ran the returns. And then we added in different scenarios a percentage of commercial real estate holdings and looked at the return changes by adding 20% allocation into the S&P 500, and they went to a 40%. And we showed 3 to 5 times higher returns to the overall investment portfolio with simple, honest diversification. It's remarkable.
And you know, it absolutely is so true. And I'm glad that you're able to provide a tool for people where they can go in and check it out on their own, because once you see it and you look at the real numbers on a spreadsheet or on a screen, you're like, what am I doing? Right. What am I doing? Why would I ever be invested here? How could somebody try to sell me, and a lot of times successfully sell me on the fact that my, you know, S&P 500 is going to do better than an alternative investment like real estate? I mean, I just don't understand how it's legal, to be honest. I don't get it.
I agree with you. And the numbers don't lie. I mean, you know, the traditional financial advisor, the old saying is, just don't sell, hold. The market always comes back. But those numbers, when you analyze it, aren't true. you have to, first of all, get back to par. And then you've got your opportunity cost loss there. So when you really look at the numbers from that perspective, Wall Street's scary. But it's still an important asset class or an investment class for investors. It's just investors need to understand that diversification is not all inside Wall Street.
Is there a simple diversification number that you can give, like a 30-30-30 in those three different buckets you were talking about, or it should be more? I mean, I have my own opinion, right?
Right.
I feel that you should be heavy in one of those buckets because it's a little bit more. Well, let's just be real. It's safer. I mean, you can see it, you can feel it, you can touch it. It's giving off cash every month. It's getting appreciating in value, getting tax benefit off of it. So, I see that you should be heavily weighted in one more than the other two, but do you have a simple answer for that?
Of course not. It really depends on the person, and age is probably one of the main factors. And what their ultimate goals are. If they have retirement goals, younger guys, like we said, could be all in. And I don't have a problem with that because you can weather the storm. And you can focus your assets to have more of an impact. So I would wholeheartedly agree with what you're saying for yourself. But if I'm 65 and my wife and I want to retire and travel to Europe in 5 years, having everything in a risky stock portfolio or, and I wouldn't even say real estate because real estate's still safe. But what we see is a lot of people are betting on their Social Security and then they're still in mutual funds and ETFs, and there's going to be a loss. It's history. There's going to be a loss. So at 65, if you turn 66 and we have a bear market and a 40% correction, can you afford to do that? Because you're not going to live long enough to see the recovery.
Well, and I know there's a ton of people that really got burned, and I mean
right.
burned in the last Great Recession, that lost 40, 50, in some cases probably more of what what they had with the nest egg they were betting on was.
Right. You're talking to one right here.
Well, and I mean, those life experiences, and that's the point of this show, is to try to help people to learn from other people's, mistakes, frankly, and how they can learn from other people's advice that have been there, done that, and gone through some cycles. It's very different. To be honest, I have not been through a full cycle myself. I just haven't. I haven't been in the business place long enough.
Yeah.
But I try to learn and educate myself as much as I can on how I can avoid mistakes.
Right.
That could be.
It's. I would. Surround yourself with guys who've been through it. I remember when we were leading into the 2007 crisis, a lot of the older guys would start telling us, like, guys, save your money. They knew it was coming. No one knew it was going to last as long as it did, but they were already warning us younger guys to save your money, save your cash. You're going to need it. So get around experienced guys, guys who've been through these cycles. If you're just starting out.
Amen to that.
Yeah.
Well, Mike, it's been really good to have you on the show. Once again, I appreciate you sharing all of your knowledge and kind of, your aptitude to help people and to get people to understand what their options look like, and that, kind of free them from the traditional constraints of the marketplace, and I think that's really huge. And especially you're providing a tool for people to be able to look at their current investments and really show the difference and how they can, could do better in alternative investments, etc. So that's great. Mike, are you ready for a quick lightning round?
Sure. Sounds fun.
All right, let's do it. So the first question is, how does your mindset have to change to migrate into more of an alternative investment route? How does your mindset have to change to get there?
Well, I think you have to be open-minded and understand that, having a mutual fund or ETF is not the end-all, end-all. And you really, with the lack of returns with interest rates, can you really survive on a 2 or 3% return? Without allocating into alternatives, you're never going to be able to impact your overall returns. So you've got to open up to all these opportunities. Mm-hmm. Traditional investing is just not going to get you to the finish line in retirement.
I love it. It's a great way to go. What are you reading right now?
I just finished the Charles Schwab's new biography, Invested.
Invested? Is that what it's called?
I think it's Invested, yeah, or Vested, yeah. And it was great. It's, it was a lot of similarities. I mean, Charles Schwab, was the pioneer of the discount brokerage firm. And, I'm trying to pioneer this what we call integrated portfolio management, bringing in the alternatives with the traditional planning without any kind of conflict. So a lot of great lessons to learn there.
Yeah, I mean, that's certainly a book that you could really pick a lot of pointers out of. 10 years of anything, have a lot of impact there. So appreciate you.
Absolutely. Sure.
So what are you trying to learn? I guess it kind of goes hand in hand with that question.
Well, I'm trying to learn to be a better teacher. I really enjoy that. I love mentoring, and I want to be better at it. So, I want to become, a college professor without being a college professor.
Well, that's admirable. I think it's something that we all strive to. Well, I know I strive to be a better teacher as well. It's a continual process. That's one thing I've learned about it, and I appreciate you sharing that. That's
and the cool thing is, Scott, every successful person enjoys that. I mean, I've never met a super successful guy who's not willing to lend some help.
Absolutely.
Yeah.
It really helps to sharpen your own sword. Really.
Yeah. Absolutely.
That's what it is.
Mm-hmm.
Do you have a superpower, something that really sets you apart?
I think tenacity and persistence. You're going to get kicked. You're going to get kicked in the teeth a lot of times. And some things are just completely out of your control. And you just got to get up and keep moving and shake it off. Yeah. And every deal, every crisis you go through, it just makes you stronger and stronger. And I think that is my superpower among many.
Well, no, I mean, and that's so important. It really is. Everybody gets kicked, especially in this business.
Yeah, it's impossible not to. Mm-hmm.
External environment things happen, and you feel like you get knocked down, but you have to stand back up again. If you never quit, then you'll never lose, right? I mean, that's
absolutely.
So, Mike, how can the listeners find you if they want to once again get involved with you? If they want to maybe invest in some of your deals, or learn about some of your deals, or even just check out their own portfolio? I know that we're going to put a link in the show notes.
Yeah.
What else can they find you?
I tell you, I've got a dedicated personal email for your listeners. It's very simple. It's Mike Brown 1757 @gmail.com. You can email me right there, and I'll know they're coming from your show, Scott.
Perfect.
And we'll be happy to give them analysis and audit on their asset allocation at no fee. And if they want to learn more about real estate investing, we have some free white papers and downloads on our website at redfoxcapital.co, not com.co.
Okay.
We'd be more than happy to help or answer any questions that any of you all may have.
Sounds great, man. Well, we're definitely going to put that in the show notes. So for all you listeners out there, if you're driving, of course, as I always say, make sure to pull over before you check out those show notes, and reach out to Mike. He's got a wealth of knowledge. He can help you out. And I think, it might change your life, might change the trajectory of your life. And of course, if you like the podcast, obviously, if you stuck with us to this point, that means you loved it. So make sure to like, share, and subscribe to the podcast. Share it to all your friends. Make sure they can get the same information so they can help change their life. And with that being said, Mike, thanks again for being here. We'll talk to you real soon.
Great. Thanks.
All right. See ya.